Okay, well, hello everybody, and thank you so much for attending today's webinar, in which I'll hopefully go through what slippage is. But more importantly, I would like you all to understand that slippage is a structural element to the market, and that you should be prepared to understand why it happens and how it affects your trading strategy. For those of you who don't know me, my name is Juan Colón. I am the CEO with DarwinX. And given we are a broker whose job is to get you the best liquidity that's available in the market, I'm reasonably familiar with what slippage is and why it happens. So feel free to ask any questions and interrupt as you see fit. Because I think as you'll see as the session progresses, there'll be a few things that will surprise you about it. So let's get going, and let's get going with a pretty basic starting point that very few people actually question. And the term that will be questioned today is what the market price is. I'm pretty sure all of you guys have been taking a close look at the MT4 at your MT4 terminal for the last hours and days and months. But not enough people actually question how the price that they see on the screen actually comes about. And if you don't understand that, then it's actually quite hard to understand what slippage is and how it works. So with that in mind, let's get going with something which sounds like a truism. And the market price is a price level at which the demand for a given asset and the supply for such asset actually meet. So let's have a look at a screen which shows a bit of that. So what you can see here is a live feed of the prices that DarwinX is offering right now, real time. These are the spreads you can see if you use our MT4 terminal. And as you can see, let's just have a look at, say, the euro dollar. You'll see that, well, the current price for the euro dollar is actually the level at which the bid and the ask meet. And you can see different prices at different depths of the book. So you can see the further you go down away from the bid level, there's an increasing amount of liquidity. You see in aggregate, if you were to wipe the order book at this point, you see there's like 55 or between 50 and 60 million dollars of liquidity awaiting for you on the bid and on the ask side. Of course, the spread actually widens the more you go away from it. And you can see, for instance, if you check the top of book price, which is what you would see on the MT4 terminal, you see that the spread is actually very, very, very low. You can see there's almost 0.1. It could even be choice at times. But if you want to place larger trades in the market, you can see that the more you want to produce, the higher the average weighted spread is at which you can place your trades. For instance, you could place up to 500K within 0.2 pips. But if you wanted to place 10 million in the euro dollar right now, the average spread for your 10 million ticket would be between 0.6 and 0.7, which means the first couple of minutes would be filled at 0.2, but when you're placing that at a level of 10 million, you've already gone in excess of 1 pip, because you're wiping the order book. So far, so good. Everybody with me? Right? Okay, so as I said, feel free to ask any questions and put in any comments, because I'll try to take them there and then if they're relevant to the point that we're discussing. Right, now on to this topic of slippage. Now, how is it defined? Well, it's you can check it out in Investopedia, but roughly speaking, if you're trading in an organized market, slippage is the result of something that you're trying to buy at a certain point no longer being available for the price that you wanted it. I've put in a photograph here of one of these crowds that form whenever the iPhone or what have you is released. What happens there, for instance, if you're trying to get an iWatch recently, what could have happened to you is that you went to the Apple shop and there weren't any iWatches left by the time you got there, because so many people had gotten ahead of you that it was unavailable. When it comes to buying, say, the euro dollar, what can happen to you is, as you can see, let's just go back to the price price feed that we see here live. This is changing all the time. And if I chose to click right now, maybe I would get a certain price, but because it's moving multiple times within a second, it could be that by the time my order hit the order book, it was already, the order book had already moved, and the price that I got would no longer be what I had gotten when I clicked the button. So, and this is where things start to come together. So by the time you see a price on your MT4 terminal, that price is already the reflection of where the order book was by the time that that price actually left the server of your broker or the market and it got to your MT4. And depending on where you are in the world and how fast your internet connection is, it could be that there is between 1/10 and 3/10 of a second of difference already. So what happens then? You click the button and you send your order, which then travels back through the internet towards the market. And then again, 1 to 3/10 of a second will have elapsed in addition to the original one. So depending on where you are in the world again and how fast your internet connection is, from the point where you click the button until you get to the market, you are actually trading on a price feed, which is already between 3 and 5/10 of a second old, which means normally, if the market is moving the way it always does, you should already be hitting a different price from that you saw when you were trading. So slippage really should be a market reality, and it should be rare if you're really trading with a proper broker that you actually hit the price that you were hoping to have. Is everything clear so far? Right, okay. Well, I'm surprised that no one's really saying anything, because really, if you check out the internet forums and so on, you'll see that a lot of people really see the existence of slippage as a ripoff or a certain fraud that the brokers are playing on them. And this is actually, well, it could be that someone's actually using slippage as an excuse for fraud, but the fact is, honest brokers, actually, one of the best ways to tell whether a broker really is a broker that's providing you market liquidity is whether you have slippage. If you don't have any slippage, then you should be highly suspicious on whether you're actually trading the real market. Which is right. So I've got the first clever questions here, and this is about news time slippage. Right now. Unfortunately, there's no major news being released right now, but what you would see if you came to this order book when there's any news being released, you would see that there's a lot less depth of market. So you would see maybe like only 10 million in total for the order book being offered during, say, NFP. And you would also see that the level, the distance between bid and ask, in other words, the spread, would be very, very, very big. And the reason for that is that whenever news are released, there is a very, very limited depth in the market. And because the liquidity providers are very unwilling to offer liquidity at all. So the effect of slippage during news is even more pronounced because the price feed is very volatile. So in the time frame, in this time frame that elapses from the point where the order book is meeting until you get there, when there's a lot more volatility, the market price could have moved by a lot more. Therefore, you should expect significantly higher slippage at that time. As a matter of fact, I will go even further. The real liquidity providers, the kind of the interbank market for foreign exchange, is pretty much non-existent during news releases. What you see there are typically less like non-traditional providers who know that most of the traders who trade during news releases actually end up losing money, and they're willing to take that risk because there's money to be made by taking the losses from guys who are actually doing silly things by trading during the news. So that's basically what explains news time slippage. It's not really special times. It's really that the market moves a lot more, and therefore the effect can be a lot more pronounced. Okay, so once again, slippage is part of trading. If you're not prepared to be slipped, then several things can happen, and let me get into that. So there's a question during the Swiss franc fall. Actually, very good question again. Thank you, Viswanathan. Well, what happened during the so the Swiss franc was that the bid was at 1.0 and the ask was at 1.2, and there was nothing that met in between. So there was a jump from 1.2 to 1.0, and there was nothing you could do in between. So that was a very extreme case of slippage, if you want to meet it like that, because the market moved without any point in the middle from 1.2 to 1.0. And that was an extreme case of slippage, because there was just, for about 5 to 10 minutes, there was just no order book. No one was willing to provide liquidity in the Swiss franc at that point. Right. So there's another question: was for how long after the news there's a significant slippage problem? Actually, I could. I've got a chart on that, Mano. If you write to me, I'll send that to you. But it could be after even 1 hour after the news release that you still face abnormally high volatility conditions, and that's actually a very good point. So. I guess one thing that few people fail to account for is that the volatility of different assets is actually very different at different points in the day. And when you're trading, even after kind of 20 minutes after a major news release, the market is still about 3 to 4 times as volatile as it normally is in that pair for those kind of conditions. So that is something to really bear in mind. Okay. So any more questions? All right, so let's get going. So now, and here's the very important point. Now, you should by now have internalized that if you don't suffer slippage, that's because you're not in the market. And let me explain what I mean. So, you're probably wondering what this guy is saying, right? I mean, this sounds a bit like heresy. Well, let me listen to me. Let me explain what I mean. So, there is only 3 ways, 3 possible explanations for why maybe you haven't experienced slippage up to now. The first one is, as I described just now, it's a structural reality of the market. So if you haven't suffered slippage yourself, that's because someone else is suffering it for you. And that someone else can only be your so-called broker, which maybe is not a broker, as I'll explain in a second. The second reason why you may not have experienced slippage to now is because you don't win consistently. If you lose consistently, someone can afford to take your slippage for you, as I'll explain in a second. And 3, maybe you have a small account, so it's okay for that so-called broker to cover your slippage in those situations. So let's get going into what's going on. So which ways could you possibly not face slippage? And this is what many so-called dealing desks or market makers or dealers, there's a lot of different words for the same term. That's how things work. So basically, let's say there's a point in time T at which you saw a spread, a bid and an ask that you chose to trade on. Let's remember this bid ask is already old news, as we discussed, because this would have already left the broker platform about 2/10 of a second. And then you send the order to the market and another 0.2 seconds elapse. And in that time, the market will have moved for sure. Now, it could have been that it moved against you, in which case, if you're still allowed to trade at the old bid, you're making really a so-called profit that you shouldn't be making because you're trading at a price better than what the market has to offer at that point in time. Or, and that would have been when the market moved against you, but your dealer honored that promise. Or it could be that the market has moved for you. That means the price actually went your way, but you're still buying at the old price. And because there is no slippage, in this case it would be positive slippage, you're suffering a bit of a loss at that point in time. Can you guys see my... Oh, you can't see my PowerPoint. So let me go back a bit, because this is important. Apologies for that. And there was something which was hidden from you. Can somebody confirm if you see a slide right now on your screens? Yeah, okay. So apologies for that. So let me repeat what I was saying. So let's say you're pricing a trade at a certain bid-ask price, and which again, it's already 0.2 seconds old. And then you send a trade to your broker, and by the time that trade actually hits the server of your broker, the market will have moved one way or the other. It could be that it has moved against you, in which case, if you don't suffer negative slippage, that's because a dealer is actually offering you a price which is no longer available in the market. Or it could have been that the price has moved for you, in which case you should suffer positive slippage. But if you don't, that's because somebody is pocketing that extra profit that you should have made, but you're not making because the slippage is not being passed on to you. Either way, the important thing to notice is that if your broker is doing that, he's actually taking a market risk. In some cases, he'll win. In some cases, he'll lose. But he is creating a market because he is offering you a price which is no longer the market price. So first point, if you don't suffer a slippage and you always get filled at the price that you request, then that means with 99% likelihood, you're not actually trading with a STP or a proper DMA broker, but rather you're trading with a dealing desk. Now, of course, whenever that happens, an arbitrage opportunity opens up. So if you know that you can open an account with a broker A, where you always get filled at the price that was offered on the screen, but you know that the price has moved against that and somebody is willing to make a systematic loss in those cases, then you can open an account with, say, a broker which is connected to the real market and a dealer which is not, and you can scalp across both accounts and lock in a risk-free profit by doing that. And that's precisely what many scalpers do. And that's one of the reasons that they're actually not welcome in such dealers. So in that situation, what you can do is you have the price at broker A and you have the price at broker B. If the bid and ask of both actually cross, as I said, this is free money lying around for you. And that's how you could make systematic profits without risk by scalping. Now, of course, the dealers are not stupid, and whenever they see that somebody is systematically being on the right side of the slippage, so on the bottom one, where the dealer is making a loss by honoring the price for you not to have slippage, then they see that and they more or less politely ask you to leave. Or they take your account, which is possible on MT4, and they pass it from the B book, where they're actually market making, and they put it on the A book, so that whenever you start seeing the real market price on your screen, and you start to get filled at the real market price, and the arbitrage opportunity disappears. This is, by the way, something that happens in many cases with people who program high-frequency trading algorithms to do just this within dealer accounts. And it works for a while, and then until the dealer notices that, and they pass them from the B book to the A book, and that. So I guess this is the core point of today's webinar. It's you should look at slippage as a proof of evolution of your evolution as a trader. Because if you lose consistently, some people would be willing to offer you accounts without slippage. The moment you start winning consistently, then you will actually be facing the real market, because dealers will no longer face the losses for you. So, and why is all that? Well, as I said, if you lose consistently, then your broker has no issues with, your dealer has no issues with filling you without slippage, because they know that whatever monies you're losing will end up being their profits, and they don't want you to be upset by facing slippage, so they take it for you. Same as when you're a random trader, he will actually fill you gladly at whatever price you want, because they know ultimately you will end up losing anyways. So the price at which you trade is neither here nor there. And things, of course, change the moment you actually start making money consistently, because if you make money consistently, then filling you at the better price, as was the case here, would result in a loss to them. So what they do is they stop B booking you and they put you on the A book, which is they pass on your trades to the actual market. So whenever you start seeing slippage for the first time, it's congratulations, because you have stopped being a consistent or random trader, a consistent loser, random trader. You started to become a consistent winner, and your dealer has started noticing that. So a lot of people at this point actually ask me, so how do I not know if my my provider is either a market maker or a dealer or a broker? How do I tell both from each other? Well, here's a little questionnaire of things that you can ask. You know, the ones that offer a lot of gearing or leverage are typically the ones that are really market makers, because it's extremely risky in determining market settings to offer too much leverage. So, for instance, there was the question of what happened during the Swiss franc. Well, during the Swiss franc, for instance, FXCM and Alpari, and I've actually done a webinar on this at FX Street, which you can look up. Alpari, for instance, had offered a lot of leverage to traders on their STP book, on the A book. So they were trading in the same direction as the losers of the Swiss franc thing. And whenever the customers had lost all their margin, Alpari, under normal conditions, should have exited the trade that they were placing with the customers, but they couldn't, so they went down because of that. And that's because they offered way too much leverage to the customers. Another good way to tell if brokers really are what they say they are is whether they have a lot of terms like ECN and STP written all over their homepage. And whenever you ask the support personnel, then none of them really knows what the heck that actually means. And that's a very good filter for bullshit. Last but not least is whether you do suffer slippage. So typically, if you do suffer slippage, that's because whether you're a broker. If you don't, as I've explained up to now, it's very likely you're actually trading with a dealer. And the last but not least, it's the question on during news releases. So actual brokers give you the liquidity that's available in the market. Whenever there are news releases, there's no liquidity in the market, so you get very bad liquidity and the spreads widen a lot. If your spreads do not widen a lot during news releases, that's very likely because you're not trading with an actual broker and you're trading with a dealer instead, who keeps the spreads artificially low to entice you to trade at all costs. There's even a better way, and that's one which is not open to guesswork, and that's by just going to the FCA page, to the page in the FCA register where your broker is. So I'm just going to show you how to do that in case you ever want to do that. So you just I hope you can now, can everybody now see my browser? Okay, well, thanks so much. So all you need to do is search the FCA register. So you can search the financial services register, go here for financial services firm. So this is the first part where you would find any broker, and then you can go, for instance, to say DarwinX homepage, which is an FCA regulated broker that I happen to be an employee of. So just sign out of my account. And at the bottom of our homepage, you can see our regulatory details, including that we're regulated by the Financial Conduct Authority with FRN 586466. This number we copy, and we then take back to the register, submit. And now we're at the regulatory page by DarwinX, who goes under the trading name of Tradeside Trading Tech Limited. This, by the way, you can do with any broker. So if any broker claims to be FCA regulated, you just go to their homepage, you find out the number, and you can come check it out here. If they're not, if you can't find them, that's maybe because they're actually lying, which is a rare thing to do because it's a pretty bad offense and the FCA will go after you. But either way, we will now go to the permission page, which lists all the permissions that we have to operate. And the activity of being a broker is called dealing in investments as principal. So dealing in investments as principals is actually acting as a market maker, whereby, say, if Viswanathan wants to go long the euro-dollar, we would go short the euro-dollar to make a market in them. But because we have this limitation, which says we are a match principal broker, what this limitation implies is that we are forced by a regulatory permission so that whenever one of our customers is going long the euro-dollar, we have to, on the one hand, go short the euro-dollar against the customer, but then we also go long the euro-dollar against the market so that we're left without any risk because we have the same risk facing our customers as we have facing the market, and that makes us a perfect intermediary who's not taking any market risk. In that setup, this is the way you can tell if a broker really is a broker. Let me repeat. So if you go to see the permission for dealing in investments as a principal, and you do not see the restriction of a match principal brokerage, that means that broker is not really a broker, but a broker dealer who has the possibility of trading against customers. So this is the way to know. Was that clear? Okay, well, anyway, for any broker regulated in the European Union, you should be able to see that in the homepage of the national regulator, because it's a European-wide permission over here. Okay, so I've got a question for once more. Again, so we have found the financial registration number for a given broker, which happens to be the one that I work for. It's 586466. So with that number, we've gone to the search page for the financial services register. So we come here. It's asking us for a financial reference number, or FRN. So we enter the number, we submit, and it takes us to the permission page for the broker Tradeside Trading Tech, which is the company name under which DarwinX was incorporated. And we go to the permissions page, which takes us to the list of permissions that we carry from the FCA. The permission to act as a broker is called dealing in investments as principal, which allows us to enter into transactions where, with enough, if you go long the euro dollar, like basically when you want to go long the euro dollar with a broker, what the broker does is to sell you that euro dollar by going short that euro dollar. If that was that, then it's really a two-sided bet where if the euro dollar goes your way, you win. But if it goes against you, the broker wins. But because we have the limitation to operate on a match principal basis, we will have entered an identical bet against the market at the same time, which means we act as an intermediary that allows you to trade against the market through us. But there's no way that we could make up a price, because we are forced to offer you the same price that we're entering on the other side of the deal. If this is too confusing, just you can email me at juan@darwinx.com, and I can actually explain that in more detail, because I'm wary of holding up the rest of participants. So we're now back to the presentation, and there's another interesting application of what happens when you offer different prices to different people. So the situation here is one where many so-called dealers know that most retail traders are actually losing money on a systematic basis. So what do you do if you want people? So if you know that you're a casino and you want to get as many losers to come to you as possible, so what do? Well, you offer very, very, very tight spreads, such as like zero spreads. And you get people to choose you on the basis of those spreads, and you get to keep the losses when they lose. Now, this is what happened to the LMAX exchange, who, let's see if we get that price. Now, you can see there's a market price that's offered to so-called professional traders, which is basically anyone. So the first thing they offer is the price which now has a spread of 0.6 in the euro dollar. Now, if you happened to win consistently on these conditions, and you happen to be placing trades with a very high frequency, then very possibly what happens then is that the liquidity providers would start noticing that you're making too much money, and then you might be invited to go trade at another venue, which is called LMAX Institutional, where people trade, but on wider spreads to discourage people who win consistently. And that's because the LPs, even in an organized marketplace like LMAX, which is an exchange, are very wary of trading against customers who win consistently. So they offer two sets of spreads. So you've seen the more competitive part of the spreads, but you can also go to the institutional side. And this may or may not work now, but you'll see that the spreads on the LMAX institutional venue are systematic about 1 pip wider than they are on the professional one. And that's because unlike so anyone's really allowed to trade on the LMAX institutional one, whereas on the professional one, if you trade certain types of strategies, which they deem toxic flow, you're no longer welcome. And that's just an application of how costly it can be to freeze the spreads and allow people to have arbitrage strategies. So then a lot of people actually ask us at DarwinX, saying, why has DarwinX chosen to be a pure broker if it could make a lot more money by trading against customers? And the reason we do this is because we want to breed winners who trade with our broker, and then we scale them with our investor platform so that people can then organize to try and make a living by beating the rest of the market, which is what we're after. And that would be impossible if we chose to profit from customer losses, which we will never do. So that was what drives me in giving these webinars and trying to spread the message. If you have any questions, now is the time to place them, and I will try to be as precise as possible. So go for it. If there's anything that I've left open up to now that you would like me to clarify on, now is the time. All right, well, it sounds like it's pretty clear to most of you. Which is kind of rare. Normally, this webinar takes slightly longer to carry through. So, all right, so it looks like there's no question. So let's give it another 30 seconds. And unless I get a question coming in, I would thank you all so much for attending this. Right, so there's a question on our platform, how much slippage is there on larger contracts? Well, that's a question that really depends. So if we go to the feed, basically you can come and see the market depth here, and you can exactly see how much slippage there is. So if you want to see the volume weighted average price, so the top of book right now is at 0.3. If we go to the volume weighted average price, if you placed a ticket for 10 million, the weighted spread would be 0.6, 0.7. Which would mean about 0.4 of slippage to place up to 10 million. That's one way to look at it. Now, of course, this really depends on the time of day and how volatile things are. So right now, I reckon this is a high liquidity moment because you've got, pretty much 60 million on either side of the book within half a bip, give or take. So right now, there wouldn't be that much. But typically, the moment you've placed more than 5 or 10 million, then you really are starting to see issues to get filled. And that's where maybe it makes sense to break up your tickets in several tranches and so on to be able to place the trades better. And that's correct. So if you place a higher lot size, you will be, all other things equal, moving the spread more. Depends, of course, on what price you're talking about. So if you're placing one lot, then that's feasible within the top of book, as you can see here. If you're placing 100 lots, then things change because that's 10 million, and then the market actually moves. You can't place 10 million the way you can place 1K. Because liquidity is a scarce good. It's not infinite. You cannot place infinite amounts of money without moving the market price. So do we place the trades onto Saxo Markets platform? So the answer is no. So Saxo Bank is our prime broker. So we source our liquidity through them in addition to LMAX. But these are, you would see the better of both market prices through our platform. So you can, feel free. You can download our MT4 and see our spread there on our demo account, or you can open a live account for as low as 500 US dollars. I guess the important thing to make, the important point to make, Mino, is that because we're a broker, it's in our interest to offer you the best liquidity possible. So we always try to find the best liquidity providers in the market. Because the fact is, whenever one of our customers gets slipped, it's actually because we're getting slipped. Right. So there's a very good question here. Is there a certain lot size with a market maker monitor when considering booking you, or is it just based on your winning rate only? That's a very good point. I would recommend that you watch the webinar I gave on brokernomics, because I explained that in a bit of detail. So the short answer is, the bigger you are, the more risk you represent to a B book or a dealing desk, which means they will be more likely to put you on the A book. So and it's actually a self-fulfilling thing. So if we go back to the points that I was making, so I said you will not suffer slippage because either your broker suffers it for you. So if you're very small, they don't mind because it's no risk whatsoever. Now, if you're very small but you start winning consistently, then at some point you will stop being so small. So they will sooner or later put you on the A book. But the point is, if you're trading with a B booking broker, it is possible that you could make more money initially than by trading in the market, but you will do so very likely by developing a strategy which is customized to work against that particular dealer and not against the broader market. So it could be that you open an account with 10K and that grows very nicely. The moment you grow that account to 50K, then it doesn't grow anymore, because what's happened is you've passed from the A book to the B book, and the point at which that happens depends on the type of broker that on the size of the dealer that you're trading with. But very importantly is, there's going to be a point at which your strategy very likely stops working because you've passed from the B book to the A book. And it's kind of very, very easy to seeing that. I hope did that help? But yes, so I know there is a size after which you start being A booked. I wouldn't dare to say that because it's not really my business to do those things. But I know the bigger you are, the likelier it gets that you get B booked, because you represent a bigger risk. Imagine you were a casino and you had a player that was so big that on a winning streak he could break you. Well, in that situation, you would basically pass that player to the market and you would not dare bet against him, which is another way of saying what answering your question. So then the question on trading indices and CFDs, the size would be interesting. I reckon I would be very surprised if someone was still be booking you if you place more than 10 lots per trade. That's, if I was to venture a number, that's what I would say. That's what if we check our VAR calculations, that's when it would really start to bite. But that would, of course, depend on the size of the broker. So bigger brokers can afford to take bigger bets. Therefore, they could afford to B-book you for longer. And smaller brokers would put you on A-book much earlier than that. So it's not just a question relating to the trade size. It also relates to the size of the broker. And then I have a question on whether slippage is a similar problem in trading indices and CFDs. Well, CFDs are, by definition, a market-making product. So there's no such thing as a CFD that you could buy on an exchange. What's going on when you buy a CFD is that you have a dealer who's making a market on an underlying, say, a given share, and they're actually hedging that on an exchange. But you are, unlike with Forex, where you can go directly to the real market, with CFDs, you have to go through a dealing desk directly. So I would expect the slippage to be much worse if you become big with CFDs than I would with foreign exchange. And that's one of the reasons we only offer the most liquid pairs. Then I have a question about index futures. So whenever you're trading a future is no longer an over-the-counter asset class. It's actually something traded on exchange. So you would very much experience slippage there, but that's because there's no way to trade against a dealer when you're trading index futures. You're already on the exchange. So yes, you would suffer slippage, but then it would be the kind of the right kind of slippage. It's the reality of the market. Because I guess that's the point I'm trying to bring across today. Is there's no such thing as a market without slippage. if you've been trading without slippage, that's because you've not been in the market. Any more points? So actually, Jakub, on your point, Jakub, on the point regarding the lot size, we're now doing quite a bit of investigation ourselves to experiment with how big a trade size becomes too big for the market to absorb. So I will be in a much better position to give you an idea of how bad the trade sizes are, and of course that doesn't only depend on the size; it also depends time of day, depends on the asset you're trading, depends on the volatility conditions of the market, and so on. Because the market is a living thing; it moves. It's not there's no one size fits all answer. All right. Any more points? Okay, well, there's one thing that I'm always very grateful for, and that would be if you have any kind of feedback on something that you think I could do better or more clearly on upcoming webinars, by all means let me know, because I'm always willing to learn. And the other one is that if there's any topic that you would like me to provide a webinar on, feel free to email me at juan@darwinex.com. I repeat, because I'm always keen for ideas on stuff that interests many traders, and I'll do my best to do some background research and hopefully give you some clarity on it. All right. Well, thank you all, guys. It's always a pleasure. Let me wish you very, very happy trading. And, just as I said, I always welcome the feedback. So if you have a few questions now, please feel free to write to me right now. And I always make a point of replying to all the emails I get. Thank you all.